Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain.
Glad you are here with us as we talk about financial matters. Both myself and my co-host here we're both practicing advisors and have been for a number of decades, and do this program because, one, we enjoy it, and two, we like to help you with some decisions with your own finances.
Yes, and like many things at work, you don't look forward to going to work, but once you're there, you're involved.
Yeah.
I feel the same way about the gym, yoga, bicycle riding, many things in my life. I don't look forward to doing them, but once I'm engaged.
My daughter was complaining about something. I don't know if I want to go tonight. I'm like, here's my experience. If it's something I know I'm going to enjoy, it's good for me. Like, I've never regretted going.
Push yourself.
Just, go and you'll be glad you did. Anyway, this is a financial program. We'll talk about
not our psychology.
We're off to another phenomenal start to the year.
Crazy.
Stock market wise.
Yes.
Of course, we had the inauguration this last week, and we're not going to talk about that noise.
Please, no.
But
we try to stay apolitical.
Yeah.
We try, but we too are human, and it may bleed through at times. So no need to actually send us emails if you see us bleeding through our political leanings at some point in time.
But it's just, the stock prices, if they grow faster than the underlying earnings, that's not a great thing.
Yes. Yeah. And I've seen a number of articles this week referencing back to Bob Shiller's CAPE index and how the stock market is grossly overpriced.
Unless we've hit some new era where people are comfortable with higher multiples than they have in the past.
Which we don't know.
Because the multiples the last 30 years were higher than the multiples the previous 70.
Yes. Yeah. Maybe there's a feeling of optimism in the air that just drives it higher and higher. Who knows?
But if you're a long-term investor, like, should you really be happy? Particularly if you're still working and saving. Like, I don't think you should be happy when the market goes up. If you're still contributing to your portfolio.
Well, Scott, that's not fair.
Well, you want to see the economy grow and the underlying earnings of the companies grow.
Understand? Okay, so I'm saving for retirement.
I'm just saying from a purely rational standpoint.
Okay.
I know we're humans. Okay. I like looking at my numbers as much as the next guy or gal, right?
Yes.
I mean, I get it. Like it's been pretty good couple years. Then when you factor in inflation, though, you got to discount about 25% of the growth you've had the last 5 years.
In terms of purchasing power?
Yeah, because what's the difference?
Yes,
Like if everything else is so expensive, it doesn't really matter.
But this goes exactly to an article that I was going to share later in the show, but I'll share it now, which goes to these. It's an article that came out on January 10th in the Wall Street Journal. How you can see through Wall Street's ritual of wrong.
Ritual of wrong?
Yes.
Is this Jason Zweig?
It is.
I could just tell by the just by the.
Oh, you haven't seen this article. Every December, Wall Street predicts which various assets will return over the coming year. Every January, the predictions begin to be proven wrong, and so they call this the annual forecasting ritual, and it's absurd. So,
it's ridiculous.
It's and the point of his article was they're not supposed to actually. Everyone knows that they don't know what they're talking about. The point of his article.
I mean, all the big banks, they have their economists. They give this prediction of where the S&P is going to finish at the end of the year.
Right. In 2024, the average return forecast for the S&P was 7.4% by stock analysts and 1.3% by market strategists. I don't know what the difference between a stock analyst and a market strategist is.
You kind of do.
Yeah, I do. I don't think there's a big difference. But between that, venture funds and private equity and hedge funds and the whole bit. But the S&P realized 26.3%. So way off. But his point is the reason they do this is to create conversations with people that are actually going to engage with them. that the Wall Street firms come out with these predictions.
So the big banks have here's the prediction. They all do it. And that way their clients would want to have a conversation.
And re-examine their portfolio to make sure that they're allocated in the proper positions.
Well,
right?
I've never been one for making predictions on the markets.
I'm not. I don't like making predictions about almost anything. Yeah. It's interesting. I just thought this guy really does. Jason Swig really does.
He took like a year sabbatical. I thought he retired or something. And he popped back up again.
Yeah, is he part of this? Remember the Zweig funds? Was he?
Maybe. I don't know.
I don't know.
He's been around a long time. Yeah. It might be. Well, did he have funds too?
Yeah, back in the day.
This isn't an endorsement of his funds or him for that matter, but I don't know that much about him. All I know is I like his columns. They put a flashlight on scams, on abuses in the marketplace,
on manipulations of investors.
And he had one last week on. It's on. I think it drops Friday afternoon, I believe. A week ago was on the conflicts of interest that independent advisors like us have with custodians like Schwab, Fidelity.
I read that.
Yeah.
Yes.
It's real.
It's real.
Yeah, it's real.
It's 100% real.
He didn't quite explain it, nor did he talk about anyway
the intricacies of it, especially for smaller advisors, that they have to actually produce a certain amount of revenue for the custodians to stay on there. So oftentimes the custodians will say, you need to kind of start doing this.
Charge your clients more.
Or you write the check.
Yeah. All right, let's take some calls. 833-99-WORTH is our number if you want to join us. You can also send us an email, questions@moneymatters.com. We're starting with Stephanie. Stephanie, you're with Allworth's Money Matters.
Yes, good morning. Thank you for taking my call.
Yeah, glad you joined us.
Okay, my granddaughter shows at our county livestock show. And if she wins with one of her projects, then, and it's a 501c3 organization, the local businesses will buy her project.
I've done that.
I don't know what you're talking about.
So what happens? Correct me, Stephanie.
Showing what?
So Stephanie, correct me if I'm wrong. So a friend of mine is involved in 4-H, and his children are involved in 4-H. So they raise steer, heifers, whatever they are. They bring them out to the county fair, and at the end of the project, they sell them, and people like me can buy X amount of beef. So I bought.
Is that what you're talking about, Stephanie?
Yes, sir. Yes,
okay.
sir. So she raises rabbits, and then she shows other projects like a plant project. And this year, she grew a plant. We had a local burn victim in our area, which I'm super close to. He worked for my company, and he was burned 90% of his body, and he lived. And so she said she did this project, a plant project, in a fire truck. She grew a plant in a fire truck, and she said, if I win, I want to give all my money to him. And so she did. She won reserve. And so all these buyers contributed over $50,000.
Wow.
For him. So now there's a dilemma because she received the fair. We've talked to the fair to see if they would be able to write the check directly at him, and they said no. So she's going to receive a 1099 miscellaneous for this $50,000. And so,
and where's the money now?
It's in a check. They haven't deposited. Okay. They haven't cashed it. They haven't done nothing because they don't know what to do. And evidently, asking different CPAs, they all have different answers.
Oh, yes.
So,
I mean, here's the kind of principle. So when you give to a nonprofit, it's supposed to go to the cause, not the individual. So as an example, I could have let's say I could set up a scholarship fund, but if my scholarship fund said it's only going to benefit children with the last name of McLean who host podcasts, and Pat did the same thing, it would be a sham transaction, and that it wouldn't be allowed because this isn't really a nonprofit. You're just trying to benefit one individual. In this case, it'd be a quid pro quo and so there's been lots of different case law, and I'm not a tax attorney by any means. There's lots of different case law over the years about ensuring that if stuff goes to charity, it actually goes to charity. So
correct.
When something like this, if there's an organization in town that helps burn victims, of which they're helping him, you can donate to that.
Understand, but she's going to receive this as income at $50,000. She can't deduct all $50,000.
Most she can do is 50. It's either 50 or 60%.
Cash because cash versus securities. So I ran into the same. Look, Stephanie, I ran into the same problem because I have a donor advised fund. And when they asked me to do this, I said, okay, perfect. I'm just going to take my donor advised fund and send it over to the nonprofit. And then the nonprofit, and they said, no, you can't do that. It has to actually go to the person that actually raised the cattle and sold it. In your case,
correct.
Plants. So the accountants told you that they can't, it won't work because of the fact that she can't give 100% of it away against the income.
She can give it away, but she can't take it. She can only deduct. It's either 50 or 60%. It was 50% for years, and
I don't know what it is today. You'll look it up.
Yeah.
Well, I guess they're telling her she's going to pay tax.
That's right.
On the $50,000. But my question is, when she and I guess they're okay with that. But once she pays the tax on it and she writes him a check, is he then going to have to pay tax?
Correct.
No.
Like a double tax.
No, that would be a gift. She can gift him the money.
But she can't deduct it.
No, she can't deduct it.
She can't deduct
laws, like she can only gift so much up in 2025.
This is a prime example. Like, look at here the irony of this. Here's this young. How old is she?
She's 11.
Oh, right. 11-year-old, beautiful 11-year-old wins $50,000 best in show, and she wants the money to go to this burn victim. And
Correct.
Congress has made it so complicated that there's no way she can get that $50,000 directly
She
to that
can't deduct it because he's not a charity. But
Right.
she can gift
and they
it.
said if he had a 501c3, then she could. And then
But then
there was
she's
all
limited.
these
But
talk-
she's still if 50,000. She could deduct half of that. But she'd still have taxable income. And a 1099.
Right. And then somebody even said, there was even a thought, one of the CPAs said, well, now it's going to be added on to her dad's income for the year, which may put him in a different taxable bracket.
That's right.
And I'm like, oh,
That's
this
right.
is such a mess.
That's right.
But she should be able to gift him money, just like
That's correct.
you can gift your kids money.
Yeah, but if
She can't take a deduction.
If it could possibly be added to the parent's income.
It seems to me the best way, to get as much as possible. You can't get the $50,000 directly to him, but as much as possible. If there's a 501c3 that's willing to help him, where she can gift 50% of the $50,000 to that, then she's got $25,000 that she's going to have to pay income on, and probably self-employment income.
So
maybe.
I did this,
and then pay the taxes, and then what's left, she can just give it to him as a gift.
I did this years and years ago, probably 25 years ago. Similar situation. I found a local fire department that actually had a 501c3, gave the money to them, and then they gave it to the person.
It's 60% of adjusted
60% adjusted gross
60%.
income.
60%.
But yes,
Okay.
there's no way all $50,000 is going to go to him. Your accountants are right.
I've heard that she's definitely going to have to pay tax on the 50, and then she can gift $19,000 in 2025.
And there's
And
no.
he wouldn't have to pay tax on
That's
that.
correct.
That's right.
That's correct.
$19,000.
Is he married?
He's not.
Okay.
He's 25.
Okay, and then she can do it
give him
again
19.
next year too.
Correct. That's what we were thinking. But I guess my question
Well,
is...
no,
is
wait. But that's not true. I mean, she could give as much as she wanted. She has a lifetime exemption.
Okay, but you know. Okay.
She'd have to file
She's
gift
11,
tax.
though.
She'd have to file gift
She's
tax
11.
return. She'd have to file gift tax return.
How complicated has this become? This is amazing.
Well, she's met with a number of
I
accountants
know.
and called a
I
national
know.
podcast.
I know, trying to figure it out, and we're like,
Well,
here.
she got this check 2 weeks before, at the 2 weeks into December. And then I'm like, oh, we got to figure something out before the end of this year. So if she was able to gift him some in 24, then in 25.
Oh, it's too late to
But-
do a
Too late.
501c3 contribution. That has to be done on the
So
calendar
now
year.
that's passed. So then now it's like we're sitting here in 25. And again, they don't have this check cashed because they don't know what to do with it and how to do it.
That's right.
And they're they got a new CPA, but I don't. Again, I've talked to 3 different ones, and I keep getting different
That's right.
ways. And then I'm like, you call the IRS and go, hey, how do you
Don't
do
call
this?
the IRS.
Now, so first of all, what she needs to do is go back and figure out what all her expenses are with actually.
Yes,
Oh,
because
there's
she's going to
not
have to,
much.
like the reality, she's going to have to file a tax return for 2024. It sounds like self-employment, 1099,
Yes.
right? So what expenses has she had? Did she incur in 2024 to offset the 50,000?
Right.
Maybe
So travel expenses. If she stayed in a
Yeah.
hotel to show this particular plant,
all that stuff.
all the expenses associated with this.
Maybe you bring it down to 48, couple thousand or something. But
yeah,
then,
that's where we're at.
but
I mean,
then,
'cause
then
honestly,
we have self-employment tax.
which is 15.3%.
And then
why
income
would you
tax.
pay self-employment?
Because-
Of the amount?
No, because
Because
she was. It would
it's
be
a
considered.
contract.
Yes.
yeah.
A service.
Unless it's some sort of
a capital
it's a
appreciation.
1099.
Because I think in the
How long
past
did it
when
take
my
to
kids
grow
show-
the plant?
I'm not. By the way, we're not experts on
listen,
winning.
You're going to have to go back.
proceeds.
We have nothing for you. I mean,
You heard this. You heard the same stuff you've heard from the 3 different CPAs, right?
Yeah.
Yeah, we talked it in circles.
So
I mean, the best outcome would be whatever the parent organization that runs this thing to say, look, here's the deal. Here's how much it's costing us by having to go through here. If she can just say, I would rather have my money go to a nonprofit, and I don't know why they legally couldn't do that.
if she donates it to a nonprofit, she can
It's too late now.
donate. Why is that?
Well, she can, but she's not going to get a tax deduction for it because she doesn't have. I mean,
Okay.
unless she has some income in 2025, and she can only deduct.
She's gonna, yeah, because because the check's not cash is what you're saying? Because she didn't
It
do
doesn't
in
matter. It
24?
doesn't matter. She
It
received it.
doesn't
It's
matter when
currency.
you cashed it.
Okay, she received it in 24. Okay.
She had constructive receipt. Whether she cashed it or not is irrelevant.
Okay, so then worst case, she'll pay tax on it.
She's gonna.
Have her.
If it's my
own-
11-year-old, I'd say this. Make sure you understand this when you grow up.
Yeah.
Yeah.
Just run it through. Run it through the sausage mill. Whatever's left, gift to the
That's
gentleman.
what I do, which is probably 37,000, maybe 35,000.
All righty.
Gift it to him, and yeah. Okay, sounds good.
I appreciate it. Hey, and by the way,
Thank you.
what kind of a plant was it?
It was a multitude of plants, but her project was called Beauty from Ashes. And she just, with her parents' guidance, because we knew this young man, like, hey, let's give back. She's been given. She's won a lot in her
long
career,
life.
her young career. And so
Awesome.
we were just looking for a way and we thought most of all she might get like 3,000. And man, the community, if you'd been there that night, unreal.
Oh, I imagine.
Like everybody's just 20,000, 10,000. I mean, it's just crazy.
Oh, that's
so
nice.
it was really a blessing. God was good. So
Yeah, and what
I
part of the-
appreciate for y'all taking
What part of the
Okay.
country are you from?
small town Splendora, Texas, Houston. It's north of Houston.
Very nice. Very nice.
Yeah.
Yeah. So great community.
I'm sorry
Small
we don't have any
community.
great
Yeah,
answers.
well-
You've talked to everybody. Like,
I know.
there's
I
no
guess
great
I'll
way to
go
do
with
this.
Whatever.
Nope.
Yeah.
All right,
I just don't
appreciate
want
the
it
call.
double taxed, so I appreciate it.
Yeah.
Thank you.
Thank
Appreciate
you.
the call.
I guess the way to do this, it could have been to the donors like, hey, don't write the check to this I know you committed last night when you were at the charity, raised the paddle or whatever. Don't contribute. We're going to instead go to this 501c3 that helps.
Yeah,
us
but how
fire
would
victims. I know.
yeah. But so Scott, I think I bought 1 or 2 of these steers, and same thing. I'm like, okay, I want it to come from my donor advised fund because I'm not going to take receipt of the meat. And then they're like, no. So finally, I scratched.
Because you've got incidental benefit from it, some sort of.
That's
benefit.
right, and I didn't want any. And so I said, just give it to a homeless shelter or whatever, food bank.
Still didn't
whatever.
work.
Still didn't work. So I ended up, but then I just said, well, I don't eat that much beef. But I was at a friend's house for a barbecue, and they served some of the steak, and then I was so disappointed in myself. that I gave it away.
Why did I give that good meat away?
I said to my wife, "This thing was
charitable intent was a
incredible."
bad idea.
That was so good. Not a big steak eater, but it was really good.
You know what's interesting about a call like this? So here's this 11-year-old, right? Who, there's some kids that just grow up with this drive. She obviously has a heart to serve. And then other kids are just victims they grow up to be victims their entire life. It's just really interesting.
And some could be siblings in the same family.
Correct. I know.
Right?
Yeah. As my wife and I always joke, we hate those parents you talk to. So, what are the kids up to? Oh, well, Bill's at Princeton. He's finishing up Princeton. He's got law school there. And then Susie's got,
You're like,
kids all sound perfect.
like what's your kid doing?
We just joke. We hate those parents.
He's just down at the Regal. Taking tickets.
He works 3 nights a week at Regal, but he's really good with the video games.
He's scooping the popcorn. I bet they don't have that at Princeton.
Anyway,
that's funny.
Yeah, and I'm also reminded. You mentioned Future Farmers of America or 4-H or something like that. So, Pat and I have lived in the same community for 30-some years. My kids have gone to public school. Oak Ridge High School is like a high school in our region, which it's very much a suburb of Sacramento.
And used to be
cattle land.
Yeah,
Cattle.
I mean, when I first moved to Eldorado Hills, there was a sign on the way in that said, "Dogs molesting livestock will be shot."
Yeah,
I always loved that sign and the song.
But you go not very far out of Eldorado Hills, and it's very much rural. So there's the next high school up is Ponderosa High School, and actually my daughter actually goes to in the afternoons at high school. She goes to some sort of animal health thing that she does there, working with animals. But they're known for that. But then the Oak Ridge kids joke around. Oh, if you're in the cheer squad, is it a requirement that you're also Future Farmer of America? And
they're making fun of.
Oh yeah, all the time.
People down the road.
The Hicks, the farming Hicks up the hill.
Yeah.
I think it's absolutely hilarious. Yeah, whatever. Anyway, I don't know why we're talking about that. Let's continue on with calls. We're in Ohio. By the way, I had never had a call like that, this last one before.
No? After 30,
it's not
28
about
years?
When do I start Social Security? How do I do Roth conversion? It was an interesting one. Frank, you're with Allworth's Money Matters.
Mine won't be as interesting. I'm sorry.
Okay.
So, mine's hopefully simple. I'm 66 years old. I'm going to start collecting Social Security in February, which is awesome. I work full time, so that's good. So I'm 66 in so many months, right? So I get that. And I'm debating which way to do this. I want to pay off some debt, some high credit card debt. Unfortunately, I got myself in this. So about $30,000 worth of credit card debt that I'm into. I know, don't beat me up too much on that, but it's true. So should I? And I have a 401k that's got $350,000 in it. Would it be better to take the money out of the 401k, pay the debt off because it's high interest, and then pay myself back because I'll be collecting $3,200 in Social Security, and just put that back into the 401k every month? So I pay for.
How much do you earn?
About $70,000.
And are you married?
Yep.
And
Together we have. Yeah.
Okay. Does your wife work?
She does not.
And what other assets do you have outside of this 401k? Do you have money in the bank or?
No, that's it. That's it.
And so you start Social
and
Security
when do you plan on retiring?
72.
And
if I'm lucky.
What do you own your own home?
Yes, paid off.
What's the value of it?
I guess probably in the 250 range.
And $30,000 in credit card. And I
why
assume the interest
are you
rates
starting Social Security? I think it's a big mistake.
Why did I do that?
Yeah, why are you starting now?
I was told by a financial advisor that it would be worth it. Do it now. It wouldn't pay. It would be more beneficial. I'd have more money to collect it at 66 in 8 months.
Are you of good health, you and your spouse?
Yes. Yeah.
Is longevity running your family?
My dad's 94, still alive.
I wouldn't start.
I would wait till 70.
I'd wait.
Unless you have some big pension that's going to replace your salary when you retire. Do you?
No pension. No pension.
So your retirement. You have $350,000 in retirement savings.
Yep.
And you're making $70,000 a year.
You have 5 years worth of income saved for retirement. You don't have enough money to retire.
No, I don't. But what I'm gonna what I plan on doing is that taking that money and just put it in my 401k until I retire.
You can't do that.
I can't?
No. It's not. It doesn't work like that.
I mean, you could have more withheld from your paycheck.
Yes. Do you have a 401k at your employer now?
I do.
Yeah, you could do that. It still doesn't make sense. And the reason you use 66 years, 10 months was that's when you could,
take it without a wage. You can earn as much as you want.
Yeah, without any sort of wage penalty. I don't
That's
understand.
right.
Well, so the answer to your question is how I would actually address this. I would actually go down to the bank, get a home equity line of credit, which much lower interest rate, probably 8 to 10% lower, and then I would convert all that interest rate to home equity line of credit, right? So the difference between there is
probably 8% or 9%. I don't know what they are.
Yeah,
today,
it's significantly lower, and the reason is because the bank actually uses your house as collateral, and the credit card company uses nothing as collateral.
That's right.
So that's why there's lower cost of money there. Then I would actually set up a plan to pay that off in 12 months. Right? Out of earned income, and I would defer Social Security till age 70
and not touch the 401k.
Because
let's step back for a second, Frank. So the reason you have credit card debt is because you've been spending more than you're earning today.
No doubt.
And so you're talking about taking money out of your retirement account, which is really for the day that you can no longer work. Because you're hoping to retire at 72, but you don't know what happens. One out of two Americans retire earlier than planned, and oftentimes it's a health issue, either of ourselves or of a loved one.
Yeah, life happens, and I have a family that needs money here and there.
Yes,
a disabled
I get it.
Grandchild. And it just adds up, and all of a sudden, the money's gone.
I get it. But do you want to be 78 and be that recipient of that?
Yeah, no, but I agree.
So this is how I would do it. I'd go to the bank, get a home equity line of credit, get $30,000 on it, take that money out, pay the credit cards off, pay that off within 12 months.
Let's try to pay it by the time you retire at 72. Amortize it over that.
So it's only
it's negligible. The payments are almost nothing.
Okay. Leave the 401k where it's at. Make sure it's invested probably 60 to 70% equities and the rest bonds and cash. Defer the Social Security until age 70 or until you quit working. And then that way you can retire comfortably. You actually taking that Social Security now, you're going to end up spending it.
You're going to increase your standard of living.
It just happens. That's how I would do it.
Yeah. Okay. Well, that is good advice.
And I don't know what the financial advisor, why they thought that taking it out. What was the point of that? What was the financial advice? What was the rationale why you should take Social Security at 66?
Well, the way he explained it was, you're not going to, if you live to this age, he did this mathematical equation. It's still, you're going to get more money getting it now than if you live to 90.
I'm more concerned about your standard of living at 75, 80, 85, 90. That's my biggest concern.
Yeah, and it increases by 8% plus a year, your Social Security benefit between now and age 70.
If you live longer than a normal life expectancy, it pays to defer. You'll get more by deferring.
People like me, we listen to people like you.
No, I get it. I mean, look, even if it was a push, I would actually say even if it was a slightly detrimental and a slight reduction of payments, I would still argue to defer this as long as possible. Because the bigger the check you're going to get from Social Security, you need that. You're going to need that Social Security check. It's not going to be just like a nice to have. You're going to need it.
Yep. I know that. It's been, again, sometimes you live in the moment.
Well, whatever happened in the past is irrelevant, right? So here's our moment today. All we can do is deal with what we've got today and make the best decision for today and tomorrow.
Yep.
All righty.
All right. Well, that is. I take your advice. All right. And thank you.
All right. Thanks, you, Frank. Yeah, we're really glad you called. It's
And by the way, if you've listened to this podcast at all, our theory on Social Security is if your income is so large that you actually don't need it to live on, take it early. And what we're doing there is we're trying to mitigate legislative risk.
And if you're at a point where, for whatever reason, you don't have as much retirement assets as you need, and you're going to need to rely upon Social Security, which the majority of Social Security recipients receive the majority of their income from Social Security.
Over 50%.
Yeah. So there's a lot of people are very dependent upon Social Security. And if that is going to be you, then defer as long as possible. If you're still healthy and can work, defer that until age 70.
Yes.
Because
There is legislative risk there. We've talked about it many, many times. But not for the people that need it to live.
I can't imagine.
Right? I'm 62. I can't imagine.
How did that happen?
I know, no kidding, huh?
We've been working together for 35
I still
years.
act like I'm 24, though, most of the time.
Until you're like back or neck or shoulder.
Oh, I know. When you get out in the morning, you get up in the morning and you're like, okay, let's just do the little test.
Anyway, you were saying 62.
By the time I'm 75, I don't expect that Social Security will continue to flow to me. Even if I started at 66 in 10 months.
Yeah, I don't expect to get it.
I wouldn't even put it in the plan. In fact, most of our advisors for those people with a higher net worth or higher income, right? You don't have to be high net worth to have high income. You could have pensions. Those are the people most at risk of losing Social Security benefits, not low income people.
I write a biweekly column for Investment News. It's an industry publication. So none of you who listened read it, nor should you, because it's all for the industry. But there's a particular writer, this woman who she's a CFP and she's an expert on Social Security, and like our concept of don't ignore legislative risk. Like if you've got plenty of assets and you think there could be means testing, that's an argument for taking it early. And I remember she was arguing against that 10 years ago. Like that was foolishness to even think that. And the last couple articles I've read by her have started to bring that up because we're getting to, it's going to be depleted, the Social Security Trust Fund at 2033, 2034, maybe earlier now that they just passed this bill to get rid of the wage elimination provision. So, and I'm sure some of you listen, if you're a retiree from a state or municipality and had some reduction in Social Security, you're going to get a bump in your Social Security.
Most certainly.
Yeah. So, but and someone, if you're in a situation like our last caller, or if your loved one, another option that he's probably going to look into somewhere down the road is reverse mortgage.
Nothing wrong with that.
To help.
That's the biggest asset you own. It's the only way to bring liquidity to it, unless you downsize. Another way.
Yeah. It is important to own a home in retirement because you don't have to deal with increasing rents.
Inflation, moving around.
Yeah. All right, we're talking with Richard. Richard, you're with Allworth's Money Matters.
Hello.
Hey, Richard.
How you guys doing?
We are great.
I listen to your show all the time, and I appreciate your advice. So I am a small business owner, really small. It's just me. And I've been doing it since 2018. I worked 23 years for a large semiconductor company and then got laid off. And I've been doing this on the side, like moonlighting, for a long time. And I decided to go into business for myself.
Oh, good for you.
I do not, I'm not an Inc., I'm not a LLC or anything like that. I'm just a sole proprietor. I do my own taxes. And so, it seems like I pay a lot in taxes. So my general question for you is, I don't make quarterly payments.
Why?
And I just don't.
When do you pay?
Did you pay a penalty every year?
When do you pay?
Yeah, I do. I do pay a penalty. So I looked it up. My last penalty it said $1,900 I paid in penalty.
What was your income?
So last year, it was $226.5K.
Oh, this isn't a little business.
Yeah. This is a real.
I was expecting some eBay sales thing.
Yeah, you're selling
18,000 last year or something.
Selling Legos on eBay. So $225,000 a year. And have you set up like a self-employment?
And do you have much expenses on that, or are you a consultant of sorts? Is it your expertise you're selling?
My expertise. I provide a service, so there's very little overhead. I work out of my own.
Yeah, I don't understand why you're not paying quarterly taxes.
Okay.
I mean, they're kind of a pain, and they don't even fall in the same months because it's January 15th, April 15th, June 15th, September 15th. So there's not even the. Is that right?
July 15th.
I guess I feel like
July
you know,
15th.
I guess I feel like I'll just keep the money, make the interest on it or whatever, and then just pay the penalty.
October 15th? I might have been the number. My month's way off. Forget about it. See, I don't even remember the months. But
So no,
I pay
I would file quarterlies. I would file quarterly. And have you set up a self-employment retirement plan? Like a Unikay?
No, I just when I got laid up, all my money got rolled over into I have two IRAs, a traditional IRA and a Roth IRA.
how much do you have in those?
So my traditional, I have just over $1 million, and then in my Roth, I have $27,000, and my wife has about, because she used to work too, she has about $150K in her IRA.
How much is your wife's income?
She doesn't no longer work. She stays at home.
How old are you?
I am 58 years old. Be 59 in July.
And is your home paid?
My home's paid for. My wife's retired as well.
How long do you think you're going to do this?
So I can do this into retirement age because it's not that physical. So I can do it.
You
And if I hired somebody, I could even do it. Even longer.
And do you have much money in savings?
So we generally put money in savings, but we generally get wiped out around tax time.
Okay. Okay. Another reason you should.
So this is one of the reasons why I'm asked.
Do you expect a pension in retirement?
I don't expect a pension. No.
You need to save more.
Okay.
Yeah, you need to save more. And one of the ways that you could do that is actually just set up a self-employment 401k. Very, very easy. You do it with one. It looks just like an IRA.
And really, back to Pat's point, I mean, part of you is like, I can do this indefinitely, which you might be able to, should your health hold up, right? But I've got a really good friend of mine. His wife had a nasty stroke 17 years ago. And like his world changed. And so like the whole, I mean, he had to retire early to take care of his wife. And like those things happen, right?
Yeah.
I mean,
yes.
And maybe it won't happen, but we need to plan for, like, we're all going to get older and eventually we're going to get sick. Like,
so if you were sitting in my office, I would say, okay, look, we need to do a couple things. One is that we're going to pick a clear retirement date. It's not going to be an indefinite, and we're going to actually aim at that retirement date. So you said you're 58, correct?
Yes.
So I'd say, okay, let's pick a retirement date of 65 or 67 or whatever. And we would actually aim your finances at that date, right? Okay. Which would be a realistic date. Obviously, life happens, it would change. And then I would actually build the financial plan backwards from that date, including Social Security, your IRAs, your Roth IRAs, and you most certainly need to save more.
Well,
quarterly taxes was the easiest thing. You got to file quarterly.
$1,900 for slight inconvenience. I mean, that's, I don't know about you, but $500 a quarter just for taking the time to write the check. It's kind of worth it.
You're going to do estimates, right? They're estimated taxes, so you're going to take last year's income.
Yeah, and the penalties are going to go up anyway because the interest rates are higher than they were year previous.
So that's a no-brainer.
But the idea of a solo K or Unikay, you can funnel about $70,000 a year into that and get and deduct it, so you don't have to pay.
It's going to lower your tax liability. And so you'd go and do a pro forma for 2025, pay quarterly taxes, start the Unikay, and then base your estimated payments on this pro forma, which is after the 401k contributions. Obviously, self-employment tax sits in there as well. But then that's how you would determine your quarterly taxes. You pay quarterly, and then you start saving more on a monthly basis. You're not saving anything for retirement, by the way.
Right. I'm not familiar with the terms you just mentioned, pro forma and Unikay.
So a pro forma would mean I'm just going to run a simulated tax projection of income for the year 2025, right? So, and a Unikay is nothing but
Solo K or Unikay, they're called both those things.
It's nothing but a self-employed 401k.
For people with no employees.
With no employees.
And they cost almost nothing to set up.
They look just like IRAs, but the limits are higher.
It's a self-employed. What was that?
It's like you had a 401k at your own employer, your previous employer. It looks just like that. You have an investment selection. You actually, rather than it come out of your paycheck, you just write checks into it.
Yeah, if you Google Unikay or Solo K, you'll find some more areas where you can read about that.
Oh, okay, great.
Yeah, but
I
Yeah, you
I
can
did
give
not
it. You
know.
can contribute. I was just looking right here. 70 grand.
yeah. So it might make sense for you to sit down with a financial advisor, pick a target date of retirement, and then work backwards as to how much you need to save to get there. And it would include your Social Security benefits for both you and your spouse. Is your house paid for?
Yeah.
Yes, my house
Okay.
is paid for.
Well, that's good.
Yeah.
But yeah, you've got to
And
pick
are you
a real retirement date.
you mentioned something about having an employee? Are you considering having an employee?
Yeah, I've thrown it around.
I mean, it does
But-
change your work quite a bit, right?
Yeah.
But I mean, it's a. But if you want to,
He doesn't want an employee.
Yeah, I
Did you hear the enthusiasm
yeah,
in his
that's what I was
voice?
just asking him.
Yeah,
But
that's
the
right,
reality is,
yeah.
you have no business to sell at this point. So when you start thinking about business, that might make sense. It might be a time to bring somebody in.
It's still a consulting business.
Yeah, I know.
Right.
Yeah, they're
Hey,
buying your expertise.
I don't get totally wiped out, when I pay taxes. I mean, we'll have like maybe 10 grand left.
How much do you have in
know.
your How much do you have in your bank now?
I think we have about 70K right now.
Okay, you make $225,000 a year. You've got $7,000 in the bank, and a bit over $1 million saved for retirement. You're
1.2 million. So you got about 5 or 6 times.
yeah, you're far away from
Not dissimilar to the previous call, which is just a different.
just different
Number.
numbers.
Okay.
You just need to. And it would,
I totally agree with Pat. If you really run the numbers, like you pick some date in the future so that you could retire, maintain your standard of living. Maybe you won't, but to be in a point where work is a total option and not an obligation.
Right.
And when you're at that point, it's quite liberating, because then it's like, I don't know if I want to work for this client or not work for this client.
Right. I'm
Yeah.
not at that point. Yeah.
Yes.
Okay.
and what
Okay,
did you
good
what did
advice.
you make at your previous employer?
When I got laid off, it was right over 90K a year.
And how long ago was that?
18.
2018.
Well, you think you've done well for yourself.
You've done great. What a great business.
I know. You said small business. Great.
What a great you should be very proud, right? And you built
And
a.
did your spouse work outside the home prior to that?
Yeah, she worked for a major bank.
And your kid, when was your last child off the payroll?
When did they
Oh,
become
we don't have no children.
Oh,
Okay.
Okay.
Just my wife and I.
All right. Yeah, you need to. I would sit down with an advisor or do it yourself and run pro formas, figure out the
you
tax.
Had plenty,
need
you
to-
have plenty of money saved to replace $90,000 your but you're about enough saved for that. You don't have enough saved to replace a $200,000 a year income.
Right. Okay.
All right.
And my guess is you haven't been spending all. You probably paid off your home over the last several years, and maybe did remodel on the house and done some other stuff like that. That would be my guess.
Yeah. No, I have. It was 3 years ago when I paid off the house, and then we've done a few small renovation projects.
There we go.
Yeah. Well, now's the time to let's save some of these dollars.
Yeah, kick it into gear.
Pay our quarterly taxes and move forward that way.
Okay.
All right. Appreciate the
All
call.
right, I wrote everything down. I appreciate you guys' information and expertise. Thank you
All right,
very much.
Thank you, Richard. And by the way, just as a reminder, these are we always encourage people to seek out their own advice. This isn't technically a client engagement.
But I find that
It's a
funny
CYA.
is that my guess is he probably won't. The consultant will not consult a consultant.
What?
He's a consultant,
Yeah.
but my guess is he won't seek out a financial advisor for consultation on his own retirement. That's just my guess.
That's probably correct.
Right. The consultant,
Yeah, well, you know why? I
the
mean, we've talked
consultant
about
will not consult a consultant.
That's just the rule of thumb. That's how it works. One of the truisms in life.
Yes, consultants don't.
I've never quite heard that one before.
I just made it up.
Oh. Do you think that's the case?
It sounded like it with him.
Okay. I kind of wonder if that would be the opposite, though.
Oh, I
What my experience is, and I know yours has, typically the more someone has their career's they've been delegators, they've been leaders of things, the more likely they are to hire advisors, because they went through their career saying, I don't have this expertise, but man, that gal's phenomenal at what she does, and he's phenomenal at what he does, and so those people tend to have no problem. They find the right person, they trust them or her, right, and
Okay, and what's the opposite of that? The people that The people that are used to delegating.
The ones that are the hardest to hire advisors are engineers, particularly engineers that haven't led big groups or led projects.
What do you think he was?
I think he was an engineer of some sort. Yeah.
He left a tech firm, making $90,000 a year. He's making $225 now. 6 years ago.
Well, and look, so he was 52 when he lost his job. Those years between 50 and 60 or 55 and 65 are typically the years you're going to make the most amount. Your income will never be higher. And your opportunity to save and invest for retirement is never going to be greater.
Yes.
Oftentimes your kids, most people raise children. The children by that point are, if they're not out of the house, they're close to out of the house.
That's the hope.
That's right. That's the hope.
That they become self-feeders at some point in time.
Yes, and a contributing members to society along with that.
That too. I was just worried about myself.
Not just a self-feeder, but hopefully someone that contributes to others. A net benefit to the globe.
Okay, all right. That was just me thinking out loud.
But look, if you find yourself in a situation like this, you need to reinvent yourself. Because we've seen, I can't tell you how many times we've seen people in their 50s lose their job. I mean, I know a bunch of people right now. Intel is
down the
a
street.
mile and a half from here. At one point, there were 7,000 employees. I don't know what there are today.
1,500.
I know a lot of people in their 50s that were just laid off, took a package, early retirement. Yeah. I don't know all their financial situations, but I can guarantee you a lot of them are not in the place that they want to be financially.
Yes, and they have to either reinvent themselves, engage in a new career.
But it's a phenomenal time to be self-employed because you can have clients anywhere and do over Zoom. It's not like having to travel out somewhere every week and show up and fly out Sunday night and show up Monday morning somewhere.
The key is clients.
Well, that is the key, getting some clients.
Why, if you could get them anywhere, you should get them. Let's go with that.
And it's also an interesting time, Pat, where we've certainly counseled lots of people in their 50s that have hated their job, counting down, I only have 7 more years. I'm going to suck it out 7 more years. And like, well, what else would you like to do? I'd actually like to do this sort of thing.
Well, then, even if it pays less income, and it
maybe instead of planning on retiring 7 years, now it's 10 years or 12 years, but doing something you really enjoy.
That adds value.
And then we find those people not in a rush to retire.
It changes the whole dynamic. Certainly.
Yeah.
Certainly.
It's quite interesting. So, hey, by the way, if you enjoy last weekend, I did this trail run.
How far?
20 miles.
What, are you slowing down?
I thought I somehow got sucked back in.
Well, you did this 15 years ago. You did the 100-mile.
Yes, I ran a Western States 100-mile endurance run,
which
starts at the base of Squaw Valley, Palisades, excuse me, in the Sierra Nevadas, and finishes at, it's about
it's all downhill.
17,000 feet of climbing.
It's all but it's downhill.
Well, yeah, but it's about 17,000 feet of climb, 17 or 18,000 feet. Anyway, I did that years ago.
Do you find it harder to run downhill or uphill?
Oh, uphill.
You do.
You can't trail run unless you can figure out how to run downhill. Otherwise, you're done.
You're just gonna hurt
that's
yourself.
the time you can kind of coast and recover.
Okay.
You can open it up and you can let the engine kind of recover. Anyway, why am I talking the details?
You ran 20 miles on a trail.
I got sucked back in because my daughter is now getting into ultras. And I ran one with her last May, and now I'm signed up. I made the mistake after the race, as we're recovering, and committing to this other one that I'm going to do in a couple weeks. So I'm training for this other 50K.
The closest I've gotten to ultra was a pair of shoes I bought called Ultras, but not actually running.
But
so you're doing a 50K,
which
is 31
miles.
Okay,
in trails. But I ran 20, and I remember at the end I was kind of beat up. Like, I'm 58.
How old's your daughter?
She's 29.
And how far will she run?
She ran 100K last fall, and she wants to do a 100-miler. She would like to do the Western States 100, but it's really hard to get into.
Oh.
So,
and she's a sports psychologist.
And she's a sports psychologist.
which I just find fascinating. I was talking to my my youngest son who went back to school to become a marriage family counselor.
Oh, nice.
And I'm like, you should check out what Hans's daughter's doing. She's a sports psychologist. And so I'm like,
we're getting way off track. She was telling us that we need to hire a sports psychologist for our 14-year-old daughter who plays volleyball. Because she plays on like a travel team, but she's not the best player. She's kind of middle of the pack player, and she doesn't really work that hard at it. She could certainly work harder, but I'm thinking,
why?
Oh my God, I'm not gonna if someone she strives to be an Olympian, great, then I'll throw all the resources behind her. But if that's not really her passion, why do I want to create it?
You mean the sports psychologist said that you should hire a sports psychologist? Very similar to how we tell people they should hire financial advisors.
Because she's her sister. How could she?
Yes. And you're not.
But anyway, my point of the story.
Okay. Yes.
So we drove. It was a point to point. As we're driving out, this guy Bill comes up and he says, "Oh, Scott, I'm so fortunate. I just downloaded your podcast because it just dropped, and I was hoping to be able to listen to it this morning on the training run that I'm going on because I love your guys' podcast." And he says, "But it drops at I don't even know what time it drops. Whatever time it drops, he was like downloading as he's driving to the trailhead, and it's not the greatest service, and he was just really excited that it was fully downloaded so he can listen to us as he does his trail run." And I'm thinking, if I had to listen to us, I don't know what's more painful, a long run or listen to us for hours.
Or both. We're doing both.
That's what he was doing. Combine the two. Maybe it's like it's a deflection thing. You got such other pain somewhere else. Okay. You don't feel the pain.
So this is a long way to get to the fact that you're trying to promote our podcast.
That's correct.
Okay. Well, couldn't you have just said it? Why do we have to go into your friend Bill and this whole running thing? Can't you just say, please listen to our podcast or share it with a friend?
Share it.
We're trying
it's actually better than there's way more listeners than we thought when we did some studies, but and now we're like, let's see where we can take this thing.
Our marketing people say we could hit the tipping point at some point in time and go viral.
Maybe it's another 30 years from now. Yeah, so make sure you give us a review and share it with some friends.
Please.
It's been great having you. This has been Scott Hansen and Pat McClain of Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.